In one of our previous episodes, we covered what a donor-advised fund is and how you can give resources to a donor-advised fund. And today, what we want to talk about are some different scenarios. These are all hypothetical scenarios, but how can a donor-advised fund actually benefit your situation? So today, we're going to talk through a couple different scenarios with a donor-advised fund. And one of them is clumping and bunching deductions. So we're going to talk about Steve and Sandy Jones. Walk us through Steve and Sandy's situation.
So Steve and Sandy are married, and they go through married filing joint tax return, $250,000 of annual income, and they usually give about $25,000 to a handful of different charitable institutions. The property taxes and other itemized deductions are $2,700. And so they exactly hit the standard deduction, which is, for this year, $27,700. So we worked really hard on this example to make sure that you could see they're not getting any tax benefit for either their state and local taxes or for their charitable gifts, even though they're fairly substantial at $25,000. So without other credits or deductions, Steve and Sandy would have a tax liability of roughly $40,000. So we want to look at a different way that they could approach things if they had some cash here. And so instead of just making these gifts on an annual basis of $25,000, if they've saved enough and they've got enough of a primary reserve, what if they clumped those gifts together into 1 year instead of doing them over multiple years, and gave 3 years worth of gifts into a donor advised fund where they could recognize the gift in that first year and have $75,000 on their deduction in that first year, and then the next couple of years just get the standard deduction. So you want to walk us through some of the details in addition to that?
Yeah, so this is where clients can often get tripped up, is because they think, well, do I have to both give the gift this year and then make the distributions in the same year? Right. And the answer is no. If Steve and Sandy in the situation, they have the $75,000, let's say they've opened a donor advised fund at Fidelity Charitable or Vanguard Charitable or National Christian Foundation, they give all $75,000 in 2023. Let's say they give it in January. Well, then they can parcel out gifts as they want, whether it's every month, whether it's every quarter, or whether it's just on a as-needed basis or as-desired basis. So they give all of what they want in 2023. Let's say it's all the $25,000. They don't have to give the rest of it in 2023. They've still got $50,000. So they can then, when January 2024 hits, they can, again, if they want to do annual gifts at the beginning of the year, they can do that. But all of the benefit for that initial contribution to the donor advised fund, that initial donation, comes in 2023. So in 2024 and 2025, what they would do is they would just take the standard deduction rather than their itemized deduction. So it really allows you to leverage the benefit of the itemized deduction in the year that you make the significant gift, but also the benefit, the recurring benefit of that standard deduction. Again, because those are equal for this couple, it really makes sense for them to clump and bunch these together. And so as a result, in the year that they make that $75,000 charitable gift, this year it's 2023, they have about $77,700 of itemized deductions. So this results in $50,000 of additional deductions above the standard. And if their marginal tax rate's 22%, it'd save them roughly $11,000 in federal taxes. If they had state taxes, that benefit could even be higher. So we really see clumping and bunching, as long as you have the cash resources to make the gift, then it makes sense to be able to do that in their situation.
And if they don't have the cash resources, sometimes there's another way. That's what we're going to get into in Brad and Brenda. We've worked really hard on these names, as you can see. But Brad and Brenda's savvy tax moves with appreciated securities. So kind of a very similar type of example, but now we're talking about donating appreciated securities, which gives us kind of an added benefit. So as we pivot to Brad and Brenda, they're a retiree couple, have a combined annual income of $300,000. Every year they donate $20,000 to their favorite charities. Additionally, they pay about $3,500 in property tax and have other itemized deductions that are worth another $4,500. So all told, in a typical year, they have $28,000 of things that could be pushed towards their Schedule A deductions. But because they're both over age 65, they are at a point where their standard deduction is even higher. there. So but they want to decide to play it smart in this set of circumstances. So they've got appreciated securities, $60,000. How do they go from here?
Well, so there's two things that they could do theoretically. If they decided, I've got $60,000 of securities, why don't I just sell them? And then I can give the proceeds from that sale. Well, if they did that, they're going to be liable not just to the capital gains tax, but there's a net investment income tax of an additional 3.8%. So their total capital gains rate is going to be 18.8%, which means that that gift, that sale is going to reduce the amount of cash that they can give from those securities from $60,000 by roughly $7,500. So then they would have to make up that additional $7,500 from cash in their bank accounts. Now, on the flip side, if they said, okay, rather than selling the stock, receiving the income, and then pushing the resources out, they could give that stock directly to that donor advised fund, bypassing the entirety of the capital gains that they would incur. And so the donor advised fund receives the gift. Oftentimes what a donor advised fund will do is they'll immediately turn around, sell that stock, and then the cash proceeds from the gift are then able to be distributed to charities that Brad and Brenda would desire to make. So Spencer, you want to talk us through some of the further details of how that can actually benefit them?
Well, there's twofold here. We're getting the Clump and Bunch benefit that we talked about with Steve and Sally in that first example, but we're also saving, and we're not paying net investment income tax, we're not paying long-term capital gains tax. So as we put all those pieces together, if we look at their tax bill and what it would be if they just went along their merry way, gave $20,000 a year, got really nothing above and beyond the standard deduction, then their tax bill would be a little bit north of $52,000. If they sold the stock, had to incur the long-term capital gains and the net investment income tax, but they were able to clump in that particular year, there is some tax savings, but they only save a little over $2,000 in that circumstance. It's about $50,500 in terms of what our calculation is for their tax bill. But if they put it all together, they donate and they do so from their appreciated securities, not having sold those, but pushing those direct to a donor advised fund, well, now we see the tax savings because they're not paying long-term capital gains, they're not paying net investment income tax, and yet that full $60,000 they're getting to declare as on their Schedule A. So that results in a total tax bill of about $43,000, so they save almost $10,000 in tax by going this path. So it can be a substantial savings if we can get everything aligned correctly.
There are some additional benefits to this that we really aren't going to touch on here, but if you've got cash available and you want to buy that stock back, then Brad and Brenda can then say, oh, I want to now buy that same stock back. You're now buying it at an appreciated cost basis. And when you go to sell it later, then you're not going to incur as much capital gain. So there's really an additional level of benefit if you can replace that stock.
And you're stepping up your basis, as you do so over time. So, and that would be donate and replace, that strategy sometimes that we talk about with clients there.
Okay.
So scenario number 3, you want to unpack it for us?
Yeah, I would love to. So Joe and Flo. No more alliteration, but now we got some rhyming going on.
Oh, wow.
Okay, so Joe and Flo are planning to retire at year end. They're at their peak earnings professionally, and both are due significant bonuses, which are going to push up their marginal tax rate to about 35% this year. So it's going to be a bad tax year for them. In this example, let's assume that they have a total income of roughly $500,000. So that total tax bill is going to be about $110,000. So it's a pretty big tax bill. However, in retirement, they expect that their marginal tax rate is going to be about 24%, and they've got about 5 years before they have to start required minimum distributions. So let's assume that they take those bonuses and are able to give some of that charitably. Rather than just putting it in their pocket or reinvesting it, they're going to give it away and cover those next 5 years of charitable gifts. So not just this year, but the next 5 years. And they generally anticipate giving about $25,000 a year. So in retirement, they anticipate itemized deductions of about $30,000 to equal their standard deduction. So again, not a whole lot of benefit by just giving the cash. But if they make the charitable gift this year, $150,000 of gifts, again, this year's plus the next 5 years of gifts that they're going to distribute in 2024, 5, 6, and beyond, they would itemize about $155,000 of charitable gifts and other itemized deductions, which would reduce their federal tax income to roughly $72,000. So it's a pretty substantial tax savings on their behalf by just taking some of that extra income, extra bonus income in a quote unquote bad tax year and giving it all at once. It's similar to that Clump and Bunch, but they're saying, oh, we recognize that this is going to be an exceptionally bad year. So let's make a bigger gift and then cover our giving until we can start required minimum distributions or qualified charitable distributions.
And that's important as we think about that planning process, because if you're paying tax at a marginal rate of 35% or even 37%, and you know that in the future you're likely to pay at 12% or maybe 22%, if you can clump those together, then we can see that nice tax savings. Again, going in this circumstance, I think from 110 down to about 72, so it sounds like about $38,000, worth of savings by just simply matching the giving with the higher level of income in that particular year.
All right, Spencer, one of our last situations, our penultimate, is Ricky and Rhonda. You want to tell us about Ricky and Rhonda and their specific situation?
This sounds like straight out of the 80s in terms of some kind of sitcom, but Ricky and Rhonda, they did really well. And with names like that, of course, their business is going to thrive. They're negotiating to sell their business for $10 million. And let's just say that they've got $1 million of basis, so they've got $9 million that would be taxed as long-term capital gains. What they're able to do is able to push before the transaction, if they line up all of the details correctly, they're able to push a portion of the value of their firm to a donor advised fund pre-transaction. And this has a number of different benefits. First, they get the benefit of not paying long-term capital gains on that amount that they pushed to the donor advised fund. Secondarily, they get the full amount of the deduction of the value of the firm. Now, you do have to have your firm appraised, and there are some details that we don't want to dig into here. They're quite deep, and there's a level of engagement with CPA and attorney that you need to do. But overall, they can see not just not paying long-term capital gains on it, but they can also have that write-off there, the deduction of the amount that they're giving. So big picture, they can save hundreds of thousands of dollars in this particular circumstance. You want to dive into the details a little bit here?
Yeah, so again, we're saying they've got a $10 million sale. There's about $1 million of basis. So there's quite a bit of long-term capital gains that they'd be liable for. So if they give that stock, though, the stock of the business, over to the donor advised fund, again, it drops that amount that they're liable to. And again, for Ricky and Rhonda, they've got a pretty big tax bill coming. So they're going to be in the 23.8%, the 20% base for long-term capital gains, as well as 3.8% for net investment income tax. So a pre-transaction gift, again, shifting about $2 million over to that donor advised fund. It's going to be a little bit less because there's some basis adjustment there, but you're shifting about $2 million into that donor advised fund. It's going to save about $470,000 roughly in capital gains just by being able to take away that and shift it into the donor advised fund. Again, what that does is now it knocks down the amount that you are incurring in the sale, but it's also increasing that itemized deduction. So you're reducing your taxable income from that about $9 million of capital gains down to about $5 million. So it's a pretty substantial drop in what you're going to actually incur, again, because of that layered nature of it. You're reducing the capital gains you're incurring, but you're also increasing the itemized deduction that you're able to write off.
And that can be very helpful on a state basis as well, whether there is state capital gains or there's franchise and excise tax, these different pieces. Sometimes the savings can even be amplified as we think about getting around some of those taxes that are due with that gift.
And again, in a circumstance where you've got a privately held business, you really need to work with an attorney. There's going to be actuaries involved, your CPA. So really, this is crucial before you think about selling your business. Once you start thinking this year's the year that I'm going to do it, reach out to your CPA and say, I want to sell. I also want to give a portion of my business to charity. So make sure that you're doing that on the front end rather than I've got a sale 3 weeks out and I want to give it away. So just a caveat there. All right, last but not least, naming a beneficiary from your IRA as a donor advised fund. So how does this work, Spencer?
Well, if you set up a donor advised fund, you have to designate what happens when you pass away as the grantor or grantors. A lot of different paths that you can go there, but you can name beneficiaries there such that when you pass, there's an automatic distribution of those resources. Now, the nice thing here is you can have your IRA distribute resources, name a beneficiary of your donor advised fund, and then when it receives it, then it will parcel those resources out to those different institutions that you've named. So that donor advised fund does a number of different things that are helpful. One of them is that it makes sure that the logistics are as seamless as possible, because a lot of charitable institutions don't do a great job of setting up beneficiary IRAs to then push the resources out. So it's kind of a hassle for them, whereas this is what donor advised funds do every day. And so they're very accustomed to these kinds of processes. Another thing is it makes things a lot easier for you. Most of the clients that we serve, their charitable interests move around a little bit over time. They may continue to be involved with a handful of different charitable institutions, but one or two of those oftentimes will change over time, or they may want to change the percentages. Those can be updated oftentimes just with a click on a smartphone, or logging in and going online and reassigning those percentages. Very, very easy process. Whereas updating a beneficiary designation, or even worse, updating your will, that takes a whole lot more time and effort to be able to do that typically. So the donor advised fund does a nice job for Andre and Annette, great names again, of being able to help them simplify their process, making sure that the charities get what they have wanted to designate there.
Well, let's just play this out for Andre and Annette. Let's say they have $2 million set aside in a non-qualified account that they want to pass on to their kids or their grandkids. And then they have another $2 million in their traditional IRA that they want to pass on to charity. Well, if they want to pass it on to 15 different charities, each one of the charities has to establish a beneficiary IRA to receive the funds from Andre and Annette. Rather, if they've got a donor advised fund, the donor advised fund is the only one that receives the resources from the traditional IRA. Andre and Annette say, these are the 15 charities that we want. Maybe 6 months before they pass, they have another 5 that they want to give resources to. So now it comes to 20. Well, they don't have to go through the process of updating 20 beneficiary designations on a form with their IRA custodian. They just have to update it via their smartphone, and they can update the percentages. It's a whole lot easier within a donor advised fund context than it is to update beneficiaries with a traditional IRA. Those are just way more complicated. And then again, each charity will have to receive funds from that beneficiary IRA, as a beneficiary of the IRA, into an account that they open. Right. So rather than just receiving it directly from the donor advised fund, the charity has to take steps. Charities are glad to receive funds. However, it's a whole lot simpler for them to just receive the funds than to set up that account.
And this is interesting in that some donor advised funds, they don't even require that you hold resources there to remain open. So we found that with some, they can have a shell account that is not having a fee assessed to it or charged to it, but you still have the secondary beneficiaries listed such that when you pass away, the IRA pushes proceeds to the donor advised fund, and then the donor advised fund pushes them out. So sometimes we have clients that say, well, I'm doing qualified charitable distributions, or I don't have a real need for it right now, but I'd like to have it set up such that it could receive resources at my retirement. That's also a possibility. You can set up a donor advised fund with some institutions where you don't even have to have funds there for it to be set up. It can receive inherited IRA resources and then push them out to the charities of your choosing. So again, another option set there that can be quite helpful for folks that want to make sure that charities get resources in an efficient way.
Well, thanks for watching this video about donor advised funds in a couple scenarios. Again, these are all hypotheticals. And if you want to open a donor advised fund, consider talking to your tax professional. It's a really good idea to make sure that this makes sense for your personal situation. Talk to your financial advisor, talk to your tax professional before you start saying, Spencer and Austin said it was a good idea, I'm going to do it. Again, these are hypothetical situations, and we hope you enjoyed it, and we'll talk soon. If you like these financial planning videos, please share with a friend, and if you have questions, Go to our website at SeriousRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SeriousRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.